So you think your Google AdSense is completely outside the GST net? Well, you might want to think again. It is a super common and honestly dangerously expensive misconception that just because Google is a foreign company, your YouTube income is totally tax-free and exempt from GST rules. But as we're going to see, the reality of creator taxes in India is a whole lot more nuanced than that.
Welcome to this explainer. Today, we are diving deep to demystify the complex web of tax laws surrounding YouTube income in India. You know, content creation has exploded into this highly professional, incredibly lucrative industry. And tax authorities? Yeah, they are paying closer attention than ever before. Getting a solid grip on these rules doesn't just keep you out of trouble, it actually signals real professionalism to brands, banks, and investors.
All right, here is our roadmap for today. We'll look at 1. The GST tipping point, 2. AdSense and export rules, 3. The 18% domestic tax, 4. Invoicing, SAC, and LUT, and finally, 5. Mistakes and strict penalties.
Starting off with Section 1, the GST tipping point. Basically, when do you actually need to register?
Okay, so the absolute crucial point here is this magic number, 20 lakh rupees. Under Section 22 of the CGST Act, GST registration becomes mandatory the literal second your aggregate turnover exceeds 20 lakh rupees in a single financial year. You don't have to register before this, but you absolutely must keep a very close eye on your earnings because this obligation kicks in instantly once you cross that line.
Actually, there is one really important exception here. If you're a creator based in one of India's special category states, that limit is strictly cut in half. So you have to register once your turnover crosses just 10 lakh rupees.
Now, what's super interesting and what trips a lot of people up is the actual definition of aggregate turnover. A lot of creators think, oh, I only make 5 lakh from brand deals, so I'm totally safe. Wrong. Aggregate turnover includes every single rupee you make across all your revenue streams. We are talking AdSense revenue, Indian brand sponsorship fees, affiliate marketing income, even channel memberships and super chats. If you run a channel and earn purely from AdSense, your total yearly receipts still count toward this 20 lakh limit, even if you never sent a single invoice to an Indian client.
Moving right along to Section 2, the two-bucket strategy, looking at AdSense versus domestic deals.
So once you are registered, you need to mentally separate your channel income into 2 distinct buckets to really understand how it's taxed. Bucket 1 holds your foreign platform payments, stuff like AdSense, super chats, and channel memberships that are processed by Google outside India. Bucket 2, on the other hand, holds your domestic income. Think of when an Indian skincare brand pays you for a sponsored video, or maybe you sell a digital product to an Indian audience. Bucket 2 counts as a domestic supply of service and attracts a standard 18% GST, which you have to collect and pass on to the government. But Bucket 1? That is an entirely different story. Bucket 1 actually qualifies as a zero-rated supply. Since Google Asia Pacific or Google Ireland sits completely outside India, and because they pay you in convertible foreign exchange like US dollars, the law considers your AdSense income an export of service. And zero-rated doesn't just mean tax-free by accident. It means the government deliberately removes the tax burden to keep Indian exports competitive on the global stage. So you don't pay out-of-pocket tax on this as long as you follow these strict export rules.
Let's look at Section 3, the real-world breakdown, featuring Rohan, the tech reviewer.
Let's ground all these abstract tax laws by looking at a highly relatable scenario. Check out Rohan's books for the year. He made 14 lakh from AdSense and 9 lakh from Indian brands. His total turnover, 23 lakh. Because 23 is obviously greater than 20, he legally must register for GST. Now, for that 14 lakh in AdSense, he pays 0 tax because it's a zero-rated export. But for the 9 lakh from Indian brands, he has to issue formal tax invoices and charge an additional 18% GST on top. That means collecting an extra 1.62 lakh from those brands just to pass to the government. So his AdSense is safe, but his domestic deals are fully taxed.
All right, Section 4, the compliance journey. We're talking invoicing, SAC, and LUT.
Listen, the absolute first thing you must do to protect your AdSense money is file an LUT, or Letter of Undertaking. Without this, you'd literally have to pay 18% IGST on your AdSense export income up front out of your own pocket and then apply for a refund way later, which, let's be honest, completely kills your working capital. Filing an LUT lets you skip all that and export at 0 tax straight away. You just log into the GST portal, furnish form GST RFD11, submit it with an OTP, and this is the critical part, you absolutely must renew it before April 1st every single financial year.
Next up, you need valid GST invoices.
And yes, even for your zero-rated AdSense exports, auditors want to see proper documentation. A valid invoice needs your GSTIN, a clear description of the service, and a very specific SAC code, 998361, which is the code generally used for digital content and advertising. For domestic deals, you list the 18% GST, but for your AdSense exports, you have to include a specific declaration that says, supply meant for export under LUT without payment of integrated tax.
And of course, being registered means filing regular returns. You're primarily going to deal with two. First, GSTR1, which reports all your outward supplies, meaning both your domestic brand deals and your zero-rated exports. And second, GSTR3B, which summarizes your total tax liability and lets you claim input tax credit on business expenses. Things like cameras or editing software. Depending on the size of your channel, you'll file these either monthly or quarterly.
Which brings us to Section 5, Mistakes and Strict Penalties. Even super experienced creators slip up here. We've already talked about the danger of assuming AdSense doesn't count toward your 20 lakh threshold and the absolute nightmare of forgetting your annual LUT renewal. But a huge blind spot is barter deals. If an Indian brand sends you a free laptop worth 80,000 rupees instead of paying cash for a video, that is still considered a taxable domestic supply valued at 80,000 rupees. You owe 18% GST on that value. Another massive mistake? Mixing personal and business bank accounts. That just makes tracking your aggregate turnover an absolute nightmare. And guys, the stakes here are high. If you cross the 20 lakh threshold and fail to register, you aren't just given a polite warning. The authorities can hit you with a penalty of up to 10% of the tax due, plus a crushing 18% annual interest on any unpaid tax. And if they even suspect deliberate evasion, those penalties scale way higher. Proactive compliance is just infinitely cheaper, and honestly, a lot less stressful than reactive penalty management.
So I want to leave you with this one question to think about. Are your channel's books actually ready for an audit today? If you're approaching that 20 lakh threshold, or if you've already crossed it, the time to act is right now. Separate your income buckets, get that LUT filed, and start treating your content creation like the professional business it truly is. Thanks so much for joining me on this explainer. Now go get those books in order.